Everyone, so welcome to Investing for Values. So today I want to talk to you about growth companies and why I like to invest in them and what I look for in terms of my investing process. So I'm going to tell you a story, and that's going to lead me to some of my reasoning of why I invest in growth companies. So once upon a time there was a king and there was a peasant, and the king goes to the peasant, "You've helped me a great lot, and I want to reward you with anything you want." And the peasant goes, "Can I have 1 grain of rice doubled on every single square of a chessboard?" And the king goes, "Well, it doesn't sound like a lot, so sure, you can have it." Then they try to work it out, and ends up when you double 1 grain of rice on every square of a chessboard, well, that's 64 squares, but not counting the original, that's 63 compounded, and that equals in the thousands of trillions. And that's a lot of rice. So it ends up the king actually looked at the figure and he thought he got swindled, so he killed the guy. But never mind the ending. To look at that whole compounding effect, that's a strong compounding effect. If you could compound $1 at 100% every year for 63 years, that's an incredible return. But you know, like, you don't need this much money, so like, let's work with lower growth rates and let's work with less years, okay? And let's work with more than $1. So you already got an advantage. You're not working with $1. You could be working with thousands of dollars. But you just have to find the right rate of returns. So you're probably not going to get 100% return, to be fair. And you know, like, that doesn't matter. Like, but you do want a very high rate of return. So like, how do we find high rates of returns? So firstly, you're not going to get it from your bank account. If you try to compound a few percent every year for the last 100 years, you know, you probably want to end up with a significant amount of money. And if you did it with bonds, well, bonds are a little higher, but you know, generally all those products kind of just give you less than 10% return compounded every year. So it's 10%, like, in terms of that, is far-fetched from this 100% that this guy was getting on his rice on a chessboard. So we have to go and have to push the boundaries, and we're gonna have to go. We want to look at high growth companies. So now you kind of start to understand where I'm coming from. I'm looking for high growth companies, so then I can like compound my return in a really incredible way. So like, time is money, but it's also, you don't want to like put it into like something that's really risky, right? So we want to maximize our return for the year, but we don't want to like push the boundaries too much that the risk is too much to handle. So when you invest in growth companies, you really have to know the company really well. You can't just invest in like 20 growth companies, because 20 growth companies, like, you don't actually have all the details of how it succeeds. So let's take Tesla as a really concrete example of a company that's in its growth stages, that's done really well already, right? So when you're looking for a growth company, you're looking for a very strong product. At the end of the day, if you don't have a strong product, you can't really, there's not much to sell, right? If you try to sell toilet paper and you go, the whole world needs toilet paper, well, I mean, you could do that, but the margins might not be that high. It could be a really competitive industry. So then we've got those situations. So like, generally in a high growth area, yeah, it is very competitive. So that's why the product really matters. You've got to have a product that is very unique, that's got some advantage, that it's better than the competitor's product. So when you look at Tesla cars, it tends to have, you know, the price tag's cheaper, the battery has longer life, and it's a very nice and premium quality car with a brand name that really a lot of people recognize, right? So like, if you were a Tesla, to really top that, you would have to go for like the really large brands before someone thought that was incredible. Like, there was like a story of like a person that drove to pick their kid up at a school, and it was in a Tesla, and all the kids saw the Tesla and wow, and they thought, well, this would probably not happen if I drove like a Ford or a Toyota. So that kind of tells you how strong the brand is. And you can also look at the fact that whenever Tesla produces cars, well, all of them just get immediately sold. There's never a car that isn't sold for Tesla. So when you have that kind of situation, you can see this company really only has to increase production to earn more money because their products sell like hotcakes. So you kind of want to look at that this company also has a long time frame. So like when you originally look at a company and you go, in the present year, I want to know this company can grow. And yeah, like Tesla can grow. Like they're producing like 50% or so more cars every year than they are on the previous year, which is an incredible growth rate. But in the medium term, you also want to know that they can expand. So when you look at Tesla, they're expanding in terms of their production line. They're opened their Shanghai factory in China, and then they're building another factory in Germany, and they're potentially building another factory in Texas. So in terms of that medium term, you've got this production line that's scaling up really quickly and really nicely. And in the long term, like on like say like a 5 year basis, you want to look at this company and go, does it have more products coming online? Because at the end of the day, like the existing products can do well, but you need new products to just keep growth coming and keep reinvigorating the market. And the thing is, Tesla does, it's got a Model Y, it's got the Semi, it's got the Cybertruck, it's got the, revamp of the Roadster. So it's got a lot of products down that line. So, like for present year, look for growth. And then in the next 3 years, you want to know the expanding production and that it's actually feasible. And in a 5 year time frame, you want to know they have new products down the line. So then basically you've got a very good idea of what's coming for this company. If you don't, then it's a bit risky because you don't know how this company succeeds. That all this attention to detail is to understand how this company fails and how it succeeds, and both is very important. So we want to like consider all those, and then after that we want to consider like the management team. You could have great ideas, but if you don't have a management team that can like execute, no matter what, like it's very difficult because like you go through the story of Elon Musk, and he talks about how he went through production hell, and he slept on the factory floor. So there's a man who's really, really willing to push what he's building, and he's willing to get it done, no matter what. So in terms of that, like it's you've got a great product, you've got expanding production, you've got new products coming online, and you've got a management team that can deliver. Like Elon Musk also has a background that he's delivered on a lot of good products. Like right now he runs SpaceX, which has done really well, but previously he had PayPal, which also did really well. And you want a CEO in terms of like this kind of large production, you want someone who's actually been there, done it before, so you kind of know that they know what success looks like, they can actually build success, and they can grow that. So like if you're an investor in Tesla, um, like you can see how the compounding grows in terms of the value. So you want to consider value. You want to consider how they grow their the sales of the cars, and then from there you can kind of see how it can translate into the share price. If we take another example, we can look at Amazon. For a long time, Amazon was losing a lot of money, and a lot of people were skeptical how good this company could do. But the one thing you really had to pay attention to was Amazon's expanding product range. So they originally started with books, and they proved themselves to be one of the best in terms of like buying books. You could think of a book and then you could buy it at a much better price than all the retail shops, and it just made it really convenient and so much better. But then over time they extended to other products, but they were still losing so much money, and that really made people fearful. But at the end of the day, if you're building a product that just is way ahead of all the competition, you just have to go to venture capital companies, and they're willing to give you a lot of money. Like you look at Tesla, like Tesla can just raise billions of dollars in the next like week if they really wanted to. So like it's very very easy when you've got like a really good product. So that's why like when you start off with something, you want to start off with a very strong product which into good margins has a competitive advantage. Like though it's subjective when it comes to the margins. Like you could look at Uber, who's created an excellent product but doesn't have like incredible margins. So it's more based on how good the product is, and yeah, eventually I guess they can just work out a mix where they can earn money. Um, but that's the thing. It like if you don't have a great product, like it kind of it's a deal breaker to be honest. So product first, management team second, and also like that they have a nice long plan of like how this company grows in the future. So when you have all those set, you're going to be very happy. And then next week consider the financials. So for the financials, you want to consider like how fast is revenue growing, because at the end of the day, like you could have a great product, but if you're not executing well and your revenues aren't growing quick, it's a sign of like how traction. Like if your revenues are growing quick, then it means the market likes what you have produced, and are buying it all up. And also, it's also a sign of your capacity to build into scale. If you have a great product but you can't scale it, then it's really pointless because it can't grow into something big, and eventually the growth rates are just going to taper off, or you're going to meet a lot of problems because um, something that's easy to scale generally doesn't have as many problems. But like you can look at Tesla, and they originally did have quite a few problems, but now that they've worked out the problems and that they can scale really well, uh, the share price has done extremely well. And also, when you've got a growth company like Tesla or something similar, the growth isn't linear. Like you can look at the revenues and they will grow, they will grow. The numbers of cars produced will also grow. And you're looking at those things and it kind of points towards a share price doing well, though the share price doesn't necessarily always reflect this. And this is where it creates an opportunity for you as an investor, but it also means you might have to wait a long time if you are a present investor in the company, because the market sometimes has a disconnect between the value produced by the company um, and the value perceived by investors. So investors generally look at they're mainly focused on the numbers, so they can miss the information when it comes to like the amount of cars produced and the amount of new products coming online. So that's the thing, like that's why I talk about the attention to detail. If you don't have the attention to detail, it makes it incredibly difficult to invest in these companies because you don't know how it would do well, apart from looking at finances, right? Um, but usually product does well, company grows that product, consumers buy that product, then it translates to revenues. So when you're looking at revenues, you're not getting the full story, you're just getting the idea of how well this product can get traction. But what if this product ends up being, outcome, like what if the competitor outcompetes them, produces a better, like say like a better car, then that product sale could just well go down afterwards. So that's kind of a thing. You understand the company's product and you understand the competitor's product. And when you look at Tesla, no other car company is even on the same level as Tesla. So that's kind of like a growth company that kind of gives you a lot of confidence for the future. Um, and like looking at Virgin Galactic, like we can see that they're also producing a product that a lot of people want. It's very expensive but high margin, and they've got a management team that's proven to be able to execute on large disruptive projects. So in those considerations, you can see what I look for, like, and after that it translates into revenues. And the next thing is, if this company makes a lot of losses, you want to know that firstly they have ability to raise cash, or they are, well, firstly, or they have the cash in the bank. Like for me, it's always more reassuring when the cash is in the bank. So like you've got a company like NIO right now where there's a lot of interest. They call it the Tesla of China, and the valuation is so tiny compared to Tesla. Tesla's like 150 billion plus, whereas NIO is less than 4 billion. And you know, a lot of people might perceive this as an opportunity. A value could be, you know, there could be value in this company, but we have to also look at the internal like situation of this company. Firstly, the cars are, yeah, like top notch. Like a lot of the cars are nice, but this is a company that's potentially running out of money. Could they raise the money? Like chances are they probably could, since they seem to have a lot of connections. Though it's also a risky point if one day, you know, they can't raise the money because they've just been burning through so much of it, and this coronavirus situation is really stopping the company from actually producing cars. And if you can't produce cars, you can't sell them because there is no cars to sell. Um, so that's inherent risk when you invest in these companies, but like it doesn't mean you necessarily like have to get fearful, you know, like um, but you know, like it's kind of one of those considerations you have to look for when you invest in a company like these. So that's why like I generally like companies in the later stage, unless they dominate the market or unless they have massive margins. So like in terms of investing in NIO, like currently I wouldn't feel that confident investing in NIO right now because they don't have enough money, and they haven't shown me a great runway towards like profitability. But the minute they can show a runway towards profitability, yeah, like it's a good investment. Like a lot of it's been de-risked, and that's the thing about Tesla. The minute Tesla showed they could make some profit, it completely de-risked the whole company in terms of like sustaining itself. So it's like that's why like originally you look at the product and the growth and the ability to expand into new products, and then once the finances are secured, then the company is self-sustaining. So like the minute you can get a growth company that's self-sustaining, that's an incredible growth company. And if you put your money in there and you let them compound it, like if a company grows 50% this year and then it grows like another 50% next year, that 50% is actually a compound of the original 50%. Like you don't get that in scenarios of like a savings rate or bonds. You might get it in terms of property when you buy a property and then value goes up. Those rates tend to be quite low, and when you want to find a high rate of return, you invest in high growth companies because then you just get really high rates of return compounded on each other. So you're kind of seeing what I'm seeing when I look at like growth companies, and then you think about the story of a chessboard. Like for every like square on this chessboard, we're aiming to like. For me personally, I'm looking for companies that are growing at 50%. Because if you can find a company that grows at like 50%, you don't have to. Like that's just me personally. Like you could grow like 20-30% and you'll still do really well, you know, like, and at those rates the company is probably a very stable company, so that's kind of gives you a bit of reassurance, which kind of leads me to the next point of like, okay, say you found a really good company, the next part is in terms of like how do you manage your risk. So you manage your risk by basically buying at fair value or at a margin of safety. Problem with growth companies is they tend to be selling at a premium. Like the premium for this growth company tends to be like valued in years in advance. So like if this company is gonna do well, people kind of go like, oh okay, you're growing at 50% per year, so we're gonna value you for the next 3 years or 5 years or even 10 years of success, depending on the product and the stability. And then we're going to come out with a valuation, and then based on that we're going to be happy with that return. Um, so then after that you just invest and wait. So the biggest problem with a lot of investors is like we're all incredibly impatient because we're young, right? So like I tend to look at it like in terms of this kind of rule, you know, like if you're say you're like 20, for you a long time frame, like I usually go like 10%, right? For you, a long time frame is 2 years. Like if you're 30, a long time frame is like 3 years. But if you're 50, a long time frame is 5 years, right? So that's why like as you get older, your tolerance to waiting actually gets better because things start to be put into perspective. So that's why like older people generally just have a better tolerance and are just really good with long-term investments. But problem is like millennials getting into investing, they're incredibly impatient, and they're very quick to take the money. They're very quick to, you know, fear that they're gonna like firstly that they, you know, there's a fear of missing out and then they buy too high, or there's also the fear of loss and then they sell too quickly. So you only want to sell a company when you believe the story has changed. Though if you believe you've made more than enough of your gain and you can find a better opportunity, then yeah, sure, go for this opportunity. Or if this company is way overvalued, then yeah, that's also a sign that you may not want to be that heavily invested into something that's too overvalued. So that's kind of what you're going through in terms of working out this process of, you know, investing in growth companies. First it's about product, then it's about management, then it's about the finances, then it's managing about the price you buy it in terms of the stock price, right? So like in terms of rules to like abide by, like if you're not that experienced about investing in growth companies and your tolerance of risk isn't that high, I would say like just try to ladder yourself into a stock. Say you're going to invest $10,000 into Tesla, right? Like the advice would be like, depending on your tolerance and your knowledge of this company, and the time frame you have, you usually want a long time frame if you want to invest in growth companies because you'll have to ride waves. Um, like if the share price dips for the temporary basis and you have to sell, no matter what, you're just going to lose money. But if you have a long time frame to ride out these waves and the share price recovers, like if 18 months ago, if you held the stock price at like 350, and then it sunk to $200, and then you had to sell, you would have lost money. But if you had a longer time frame, after 18 months, the share price comes to like $900 now, and then you can sell at a really nice profit. So you can see why like having a nice long time frame kind of benefits you, and it's kind of like a must. Like you need it to invest in growth companies because you don't want to be pressured to sell early. And if you're pressured to sell early, you could end up selling at a loss, and it's not a good space to be in if you have to sell at a loss. So make sure you have a long time frame. Make sure you buy at a really good price. And if you know, like if you don't know if it's a good price and it's currently selling at a premium, then it does make things difficult. So like imagine that scenario of $10,000, and you're looking at the stock price and you're going, it's $900, which looks very daunting. You don't necessarily want to invest in it yet, or you think, I don't want to miss out either. So you could give yourself some exposure. You could go like, I'm going to invest 1,000 or 2,000. And if it goes up, then yeah, great. I'm just going to be investing in this company. But I didn't want to buy it that high of a price because if it drops, well, the risk is so much more, isn't it? But you still got like 8 or 9,000 on the sideline. So like if the stock price drops to like $700, then it represents a higher value proposition. And then all of a sudden you can go, I'm going to invest another 2,000 or even 3,000 because the price has dropped. Um, Depending on like how you feel about the situation, like we all value things in a different way, and we all perceive like growth factors in a different way, and we only get proven right by like the actual outcomes of this company. So like you could say like, oh well, the situation of this company coming down to 500 is, you know, like is very low, and I don't think I'll ever get the chance. So you might be like, okay, well, I don't want to like save that much money at that time because if it ever came to that, I might just have more money after that anyway. So then you might be like, okay, well, when it's at 900, I'm going to invest 2,000, and when it's at 800, oh, when it's at 600, I'm going to invest another 2,000, and when it's at 500, I'm going to invest 4,000. So that'll be like 8,000, and then you've got another 2,000 on the sidelines. If anything was, you know, anything else was to happen, like you don't necessarily have to keep that on cash, but um, it kind of just is like it's there in some form that's liquid. So it could be in like a savings account, it could be in bonds, but it's money you can access immediately to take advantage of an opportunity. And that's what one investor does. Warren Buffett does that all the time. Why do you think he holds well over $100 billion in cash? It's because in his consideration, it's not about necessarily always about the company, but it's also about the price you pay. Like if you're able to pay a low price for a very good company, eventually when the stock price comes back really strongly, as it has with Tesla, like we imagine this company at $178, and then now it's well over 900. So like and that's in the space of about a year. So that's an incredible change, right? So you know, like in that, when you look at that process, that's how you make large gains. Firstly, by paying a good price. So like never feel a lot of pressure to invest at a high price, because if you put all your money at 900 and it comes to like 500, then how would you feel? Like you're going to spend a lot of time waiting on the share price to recover. Like, not that I'm saying that Tesla's going to do that. Like, I see great things for this company. 900's, you know, in my sense, a little high, but I think it can go a little higher, of course, because the market's ecstatic. Like, when you're in a bull market and you have enthusiasm about a company, of course, you know, stock's going to do well. Valuations are going to be high, particularly if people perceive great things from this company. But it also means like if it was to just drop down and hover around like 800 for a whole year, it's not really a great use of your money. So maybe after that whole year, it goes up in value by like $500, and then you feel like, oh, it's at 1,300. I've made more money holding in that 1 year than I would have in any other dividend stock that I would have been holding. So that's kind of like the perception of why people like to invest in growth companies. The main point is knowing how it succeeds, and that you track like the milestones of the success of this company. Then it gives you an idea of the value you'll be getting in the future of your stock price. So that's why when you look at a stock price, you don't necessarily want to view it as a ticker symbol. You want to go like behind this ticker symbol as a company, and behind this company there's all these great products, all these great people, and that's what ultimately translates to, you know, to the stock price. And if you know everything behind that is doing well, eventually it comes and it's realized in the stock price, and you end up doing really well out of it. So like that's kind of like in a nutshell, like how I invest in a growth company. And I hope that was useful. Hopefully the video wasn't too long. Hopefully, like, maybe just watch that all my videos at like 2 times the speed if they're too long in the future. Um, and then, you know, like, hopefully you've gotten a few lessons out of it. Let me know if you've got any other questions or companies you want to look at. Like, that's kind of what keeps me sharp as well. Like, I would always recommend that you look at a lot of companies, so you have a lot of benchmarks. You can compare different companies, And you also see how companies succeed and also how companies fail, right? So like look at a lot of companies, but never feel a lot of pressure to buy into any of them. At the end of the day, as Warren Buffett says, imagine this to be like baseball, and if someone throws the ball, you can choose to hit or you can choose to just leave it. And in investing, you can leave all the throws that come at you, but you don't want to leave it for too long. Um, but you want to make sure the one that comes at you is a good one. So like that's kind of like for me, like I don't invest in a lot of companies, but I try to focus on like a very few of the really strong and really high growth companies, so that I know how they succeed in every single detail. So when I know how they succeed, then the share price can go up, it can go down, and I can still hold my calm. Like I'm not gonna like no one enjoys a falling share price. Let's be frank with that. But I like if I invest in Tesla at $900, mind you I haven't, um, and then I just hold that, and then let's say it drops like $700. Um, then I might be like thinking to myself, well, what next? Well, if I didn't know much about the company and I just looked at share price, I'm going to panic. But if I look at the company and I go, oh well, they've got the Shanghai factory that's coming into production, they've got a factory in Germany coming up, they've got one in possibly Texas, and they're expanding their existing factories, then I think this is a company that grows a lot of value, and eventually that value will catch up. So never mind dropping share price. Like go in and go do something else. Go enjoy your life. Like for me, like it's it was incredibly difficult, like to just go do something else, because like stock investing was like my passion, something I like to just like spend a lot of time on. But over time, once you learn a lot of things, you begin to just understand what you need to look for, and then you can just like focus on your other hobbies, right? Like I will, like I can spend more time with my family, I can spend more time with my friends, I can take up new hobbies, and like it kind of diversifies your life, like in terms of investing, right? Diversification, isn't it? And it also keeps you sane, right? Like there's no point in watching a stock price daily and it's fluctuating. Like it's fine to just buy it, leave it on the bottom shelf, keep up with the how progress of this company is doing, and then just focusing on your daily things. Like a lot of people kind of have this perception that if you invest in a growth company, that you have to watch it all the time. You don't have to watch it all the time, but definitely keep up the progress of this company. And mind you, you don't have to spend a lot of time keeping up the progress. So it is a very enjoyable process. That's why like it's always good to invest in companies that you know and like. Because like if you invest in Tesla, like a lot of people love researching cars, they love researching electric vehicles or solar panels, or the sustainable future. And like you don't mind spending a few hours every week reading about that, and that's more than enough to keep you up to scratch about Tesla as a company. And if things keep going in the right direction, eventually the share price takes care of itself. So there is no pressure to just focus that heavily on a share price, especially if you're in there for the long term. So remember, I told you that time frame matters, and that's why it matters, because if you've got a long time frame, you can just let the company do its work, and in essence, it will succeed for you. Of course, and then you keep attention to the stock price. So like if it drops and you do have cash on the sidelines, you can always buy a bit more, assuming you kept up with the story. And the story hasn't changed, and and if it continues to get better, then you might just think, oh, actually I want to buy more of it, because all of a sudden the story's just gotten better, the risk has kind of dropped. And the thing is, companies, they go through all these different stages, and each stage that they go up from, the risk is reduced, and from there it means you can put more and more money into it. So like most companies would have started like a tiny company, that could have had like all sorts of risks, but as they built up into larger companies, the risk goes down, and then that means you can put more money into it, knowing that it's not just going to fall over the next day. Um, so that's kind of like my process of looking into these companies. So I definitely hope this was helpful. It's, like, yeah, like I think at the end of the day, it's not a foolproof kind of way of looking for companies, but it is one that, if you hold to a high criteria, it's gonna really aid you in a lot of situations when you try to search for a good company, and it's going to be able to keep you um, like calm in the face of adversity, like when the share price is dropping or the company might be experiencing a little bit of trouble. The main focus is focus on the company, focus on the products, focus on the management, and make sure they're the ones that are delivering. And the share price eventually just takes care of itself if those things are delivering. So I hope that's helpful, and until then, good luck investing everyone, and do let me know if there's more things you want in terms of company analysis, or you've got questions about investing. Always willing to help. And thank you for all the subscriptions. It's definitely nice just watching those slowly trickle upwards. Managed to pass some 100 subscriptions, like 132. So always happy about seeing that number just tick up, because that means people will just appreciate what I'm doing here, and nothing gives you more satisfaction than just being able to help a lot of people. And also means, like, it just gives you a confirmation that you're also on the right track in terms of the knowledge. Like, I know I have a lot of improvements to make, because like there's always different scenarios that come in, there's always different products, there's always like learning to do, there's always different industries coming in, there's always different competitors to study about. Like you look at Tesla, there's a lot of competitors. They're heading into a new industry, there's a lot of R&D that's going to come in. Like you look at battery technology, how is battery technology going to change the whole game of everything? And you always have to keep on to that, and it keeps you sharp. It's also a very enjoyable process, which, like, if you get really into stock investing, you'll start to understand why I enjoy it so much. But I also encourage you to explore other hobbies, and also make sure you spend all your time with the people that matter in your lives, because there's no point like building a lot of wealth if you don't have a really balanced lifestyle. And for me, I think that's important just as much as being a really good stock investor. Like, it's all about satisfaction of your life, but also, and the reason you invest in companies is one that you hope for financial freedom, and that's kind of why you invest in like growth companies, because it kind of helps you achieve that in a quicker way. But like, I mean, you can do that, or you can invest in dividend companies. Like, there's always a mix where you invest in growing companies that pay dividends, and that's like the best of both worlds. Yeah, so there's a lot of ways to succeed. Do the one that you're most comfortable with. Like, at the end of the day, if you've learned anything from this, it's about you knowing how things succeed, and you also have to know how you are going to succeed, by placing your money here. Like, if you place your money, you don't know how it succeed. The company might not succeed, and you won't succeed ultimately. So you have to pay attention to all these details. Okay, well, anyway, I better leave you there. Until then, good luck investing.